The market, as I'm sure we all know, has gone through three big phases in the recent past. We had an era where money was effectively free, and everybody was split scaling, growth at all costs, and stock prices, as well as venture activities, went through the roof. This was, of course, followed by a correction when we realized that free money might cause some inflation, and interest rates and the cost of capital went up, and so there was a very significant correction, which we'll call the Sassacre. Towards the end of last year, there was a pretty interesting catalyst in the market. ChatGPT came out, and there was a lot of optimism around AI and what it could do. And so stocks, since the beginning of this year, have largely rebounded. Although, and we'll get into it, it's really concentrated in a few areas. One of the big drivers of the market rebound is really around generative AI, and I think most people are looking at generative AI as potentially the next big computing platform that could unlock some very significant productivity gains and GDP growth, similar to what the PC did, or the internet, or mobile, or cloud. We're still in the early innings of all of this, but lots of really big bets are being placed all over the place. The public market investors seem to agree with this assessment, because the overall market this year is actually up, but most of it, when you double click on this, is really driven by 7 stocks, which are now called the Magnificent Seven, or the new FANG, if you will. If you take those 7 stocks out of the S&P 500 and just looked at the S&P 493, we'd actually be flat to slightly down. Interestingly, almost 40% of the S&P 500 this year cited AI in their earnings calls. 2/3 of those aren't even tech companies, and include companies like Kraft, Chipotle, and Ralph Lauren. The broader enterprise software universe has also rebounded, with more than half the stocks being up this year, and the median stock being up 14%, which is great. But valuation multiples, which is also something we care about, have stabilized below historical averages. And this is justifiable to an extent, as growth rates have slowed and the cost of capital has gone up. That said, companies who are achieving capital efficient growth and are meeting the rule of 40 still trade at pretty healthy levels and are trading at very significant premiums to those who don't. And while valuations are down, the fact that they are stabilizing, I think, will be really conducive to transactional activity going forward. Valuation volatility can cause pretty big bid-ask spreads, which effectively acts as a chill on transactional activity. Markets move in cycles, and valuations get driven by different factors. During the bubble phase, valuations were almost entirely driven by absolute growth, whereas efficient growth, as measured by the sum of revenue growth and free cash flow margin, is once again a big driver of valuations. And so what does this all mean for the fundraising environment in the private market? How is public market activity translated to the private market? Well, unfortunately, especially for late stage companies, because those are the companies that tend to be benchmarked against public comps, it's been really tough. The capital demand to supply ratio, which is something that's tracked by a data provider called PitchBook, is higher than it's ever been. It's at 2.7 times. So for every dollar of demand, for every $2 of supply, there's $2.70 of demand. And then when you look at down rounds as a percentage of VC deals, they're effectively at a 5-year high. And these numbers on the down round are probably understated, because they don't capture a bunch of the inside rounds that have occurred to bridge companies between rounds. Overall, activity in VC is down, with later stage companies again being particularly hit hard. But there seemed to be a fairly robust level of activity in early stage deals where seed and Series A deals were pretty well in line with what they looked like pre-pandemic or pre-bubble. Now, one area that's been particularly active is actually generative AI, which this year as a category has raised as much venture dollars as all of enterprise software. Enterprise software doesn't include generative AI. Couple things to note here is that most of the money has been invested in companies building some fairly capital intensive foundational models, or LLMs as they call them. And a large part of the funding is actually coming from big corporate strategics like Microsoft, NVIDIA, and Amazon. To fill the funding gap in the late stage VC market outside of generative AI, structured equity solutions have returned as a gap filler. Structured equity returns really help bridge gaps in valuation by shifting the risk of returns onto the companies, and that's done by introducing very investor-friendly terms into the deal structure. And these sorts of things, while can cause some misalignment within the shareholder base, can be useful in the right circumstances. So what's going on in tech M&A? Well, tech M&A took a bit of a breather this year, and will likely end the year below historical averages or pre-COVID averages even, as buyers and sellers really took some time in the earlier and mid part of this year to adjust to an environment where money was no longer free. And there was a bit of a bid-ask spread in the market because of some of this valuation volatility. Earlier in the year, large strategics were effectively out of the market, and it's because they were facing valuation compression of their own. They were facing scrutiny from activists who were looking into prior transactions, suggesting that they overpaid. And then they were facing antitrust regulatory roadblocks on existing M&A transactions. And so as a result, they've largely been completely MIA on M&A activity, but this is starting to pick back up. And we're starting to see the activity really open up in infrastructure, software, and AI. Private equity, on the other hand, is sitting on a large pile of dry powder. Earlier, I think a couple of slides ago, there's a chart that showed how much dry powder there was out there and the different vintages. They're sitting on close to $1 trillion of dry powder, and actually face the opposite demand-supply imbalance that we saw in venture. Sellers as a whole, for the most part, like those who could afford to wait, just didn't go to market, and we're waiting out for a better valuation environment or a more stabilized valuation environment. And so there just weren't a lot of transactions going to market in the first part of this year. As a result, private equity really ended up focusing on asset classes where control could be bought in the market. And so you saw a lot of take privates of publicly traded companies, and I think you'll continue to see more of those. To wrap it all up, I think some of the key takeaways from this presentation really are, there's been a bit of a public market rebound, and this has really been driven by the promise of what generative AI could do for GDP growth and productivity. Efficient growth, i.e. growing in a capital efficient way, has returned as the primary driver for valuation. Raising capital in private markets, particularly for late stage companies who are not generative AI, are still facing a number of challenges. The supply-demand imbalance of VC money really means that companies might have to start becoming a little bit more creative and look into structured equity solutions where the circumstance is appropriate. And then lastly, strategic buyers, we think they're cautiously resuming M&A activity. We talked to a lot of the big strategics like Microsoft, Salesforce, IBM, and so on and so forth, and they are coming back to the table in some of these transactions. But doing so in a much more cautious and measured manner, outside of generative AI, where all bets are off there. And then in the private equity world, they're actively seeking opportunities. In fact, for A plus assets, they're bidding sort of close to 2020 type valuations just to get transactions going. And this is largely driven by a shortage of sellers going to market. And I think I did this in under 15 minutes.